All right, today we are diving into a really fascinating analysis, one that describes the entire global financial system as a debt Ponzi. That's a huge claim, right? The idea is that it's all built on a massive structure of promises that, according to this source, can, well, never actually be repaid. So that leads to the big question, doesn't it? I mean, you look around, governments, big companies, even regular households, we're all buried under these huge obligations. So why hasn't the whole thing just collapsed? How does it keep chugging along? Okay, to really get this, we have to understand the core concept here. The source isn't saying it's some kind of illegal scheme. Instead, it's framing it as a system that, just by its very structure, needs two things to survive: a constant flow of new money, and maybe even more important, a constant flow of confidence. Without those, the whole thing grinds to a halt.
So here's how we're going to break this down. First up, the invisible expansion. Then we'll look at the new collateral. After that, the final levers. And we'll wrap up with what's called the quiet consequence.
All right, let's get into the nitty-gritty. The first part of this is all about how credit keeps growing, but kind of behind the curtain. We're not talking about big, flashy announcements. This is the stuff that happens quietly, mostly out of sight.
So the thinking here is that even when you don't hear about quantitative easing or money printing, there's a quieter version that's always on. Old bonds mature and they just get rolled over into new ones. Special liquidity facilities pop up to keep the markets from panicking. And really, there's this unspoken assumption, right, that central banks will always be there to backstop everything. It all creates this illusion of stability, but all the while, the dependency on that support just gets deeper and deeper.
Okay, the next piece of the puzzle is something called financial repression. It sounds complicated, but the idea is actually pretty simple. It works like this. As a saver, the interest rate you get on your money is less than the real rate of inflation. So what does that mean? It means your savings are slowly losing purchasing power year after year. Now, for the state, this is a pretty sweet deal. It's quietly chipping away at the real value of its own debt. This is what the source calls a silent transfer of wealth, from you to them.
And this leads right into the next point. Think about it. When the regular regulated banks start to tighten their belts and lend less, the demand for credit doesn't just vanish. Nope. It just moves into the shadows, into less visible parts of the system. And the source points out that loans to these non-bank places hit a pretty staggering $1.2 trillion by March 2024. And this is where it gets really interesting. Look at this comparison. You've got a 20%, year-on-year jump in this shadow credit to places like hedge funds. And at the same time, regular old commercial loan growth was just 1.5%. So the takeaway here is pretty clear. The system is absolutely still expanding. It's just happening in places where most of us aren't looking. All right, so if that's how credit expands in the shadows, what's next? Well, the argument is that when all the traditional assets, houses, stocks, bonds, are leveraged up to the hilt, the system has to get creative. It has to go out and find brand new things to turn into collateral, new things to back up even more debt.
And this is where something like Central Bank Digital Currencies, or CBDCs, come into the picture. On the surface, they're about direct payments, maybe even things like UBI. But the real game changer here is the idea of programmable money. We're talking about embedding rules into the money itself. Rules about how, when, and where you can spend it. The source has a powerful phrase for this: the securitization of human behavior. It's like our spending patterns themselves become another asset to be managed within the system. And it's not just about CBDCs. You also have things like tokenized deposits and regulated stablecoins being pulled into the official fold. But here is the crucial link. According to this analysis, they all have one thing in common. Their foundation, their core collateral, is government debt. So what does this do? It creates a whole new source of demand for that debt, all packaged up nicely under the banner of financial modernization.
So what other new frontiers are there? Well, according to this analysis, how about nature itself? We're talking about the process of taking natural resources, forests, wetlands, entire ecosystems, and turning them into financial assets on a balance sheet. Now, the official story is that this is a great way to fund conservation, but the source argues there's another angle, that it's actually a way for governments to create brand new revenue streams and, you guessed it, more collateral for more borrowing, all with a nice green sustainability label on it.
Okay, so what happens when all of these clever ways of expanding credit and finding new collateral still aren't enough? Well, according to this analysis, that's when you get to the final levers, the last resorts. First, you tap into existing pools of wealth, and second, well, if all else fails, you just rewrite the rules. Have you ever heard policymakers use a phrase like this?
Unlocking private capital. It sounds great, doesn't it? Very proactive, very positive. But the source here urges us to dig a little deeper and ask, what does that actually mean in the real world?
Well, here's the interpretation offered in this analysis. That kind of language is a way to frame the process of, let's say, encouraging our long-term savings, like our pension funds, to buy more government debt. See how that works? It's presented as a great investment opportunity, not as a necessity for the system.
And then there's the other lever, rewriting the rules, or at least rewriting the definitions. When reality starts to look a little shaky, you can just change the words. So banks are allowed to pretend their government debt is worth what they paid for it, hiding losses. Big market bailouts are called temporary liquidity facilities. New kinds of digital money? Oh, we just won't include those in the official money supply data. It's all about using accounting and language to keep up the appearance of stability, even when the foundations are creaking.
So that brings us to the real bottom line, doesn't it? After all of this, the invisible expansion, the new collateral, the clever rule changes, what does it all actually mean for you and me?
The conclusion of this analysis is that the outcome probably isn't going to be some big, dramatic Hollywood-style crash. It's something quieter, something slower, a gradual, steady erosion of your purchasing power, a slow drip transfer of wealth from regular households to the big institutions that sit at the very center of this whole system.
And let's be really clear about this. The argument here is that none of these things are actual solutions. They don't fix the fundamental problem, this huge imbalance between all the debt that's been created and the real economy that's supposed to support it. Really, it's all about kicking the can down the road, buying time, maintaining the appearance of normality even as the system underneath gets more and more fragile.
And this is where the analysis leaves us, with a quote that suggests the ultimate tool isn't financial at all, but psychological. It's about shaping our perception of reality. And that leaves us with a really big question to ponder. In a system that depends so heavily on confidence and appearances, how can any of us tell the difference between what's real and what's just for show?